Are you someone who likes to look at real estate listing sites and consider different properties, whether they might be a potential real estate investment, or maybe you're just looking at it daydreaming, which is always fun to do too. But when I'm looking at real estate listing sites and considering whether or not a property is going to be a good real estate investment in terms of making it into a positive cash flow rental property, there's one tool I like to use as my initial instant evaluation on whether or not I should consider that deal further and take the next step in further calculations. And that is the 1% rule. My name is Kaycee. I work with Rentec Direct property management software. I'm also a landlord, a real estate investor, a real estate developer, and I've been writing about real estate related topics for over a decade. And today we're going to talk about the 1% rule when it comes to evaluating potential real estate investments and deciding whether or not that's going to be a good, profitable rental property. So the 1% rule is pretty simple. Basically, you look at a listed purchase price. You take 1% of that price and decide whether or not you think your market can sustain that 1% of the purchase price as a potential monthly rental income. So as an example, let's take some really simple numbers for this. Let's say there's a property that is listed for $200,000. 1% of that $200,000 would be $2,000. So does your market sustain, or could that property realistically charge $2,000 per month in rent? If so, you have the potential for a good real estate investment. Now, there's so much more that goes into determining whether or not a property could generate certain rental income besides just this 1% rule. We're talking additional expenses. Does the property need maintenance? Are there HOA fees? What does insurance look like? What does property tax look like? That all goes into additional calculations that really help you determine whether or not a property might be a good investment. When you're also looking at rental property rates for the monthly rental income, there's lots of other factors that could come into that. How many bedrooms are there? What's the square footage? What neighborhood is it in? What kind of renters can you attract? There's different classes and properties that say, you might say it's a Class A, Class B, Class C properties. That usually has to do with the level or quality of property and maybe what kind of neighbor it is, what condition it's in. So is the property in the class group that you want it to be? And is it in a class that can generate the rental income that is equivalent to that 1% of the property? So once we determine a 1%, that's where I usually say, take the next step, and I go to my partner and I say, okay, I think this hits that 1% rule. Let's continue to go to the next step and do a cap rate analysis to determine if this could be a good investment for us and if it's a deal that we want to make an offer on. Now, the 1% rule used to work really, really well in our area and in the market where we own a lot of our rental properties, because 10 years ago, prices were very different in our area. Now, 1% doesn't work so well. So when I do see a 1% opportunity, I'm quick to jump on it and take that next step in evaluating. But there's lots of markets across the country where 1% might work, but there's other markets where it definitely might not work. Think about properties that might cost $1 million to buy. Can the market rent sustain $1 million or 1% of that $1 million for a monthly rent? It just kind of depends on where you're living. Or other places that might have super luxury real estate, they might be able to sustain that 1% of a very expensive piece of real estate. And so it definitely depends on a lot of factors, but I like to use that 1% rule as the initial evaluation that I make. Some of the other tools real estate investors use for making decisions on that first step towards evaluating whether or not a piece of real estate is going to be a potentially good investment are that 1% rule, considering gross yield, the cash on cash return, doing a cap rate analysis, and then using something called the 50% rule. So if you're interested in learning about any of those other real estate evaluation tactics that some of my investor network use for determining if a property is going to be a good investment, let me know. My name is Kaycee. I work with Rentec Direct. I talk about everything from real estate investing to being a landlord and property management tips on the Rentec Direct blog. Please check me out there, and I'll see you next time.